Welcome to the Wealth Builder's Blueprint, Investing 101 for Complete Beginners. In this course, you'll learn the fundamental principles of investing and how to start building your wealth today. The power of compound interest is one of the most important concepts in investing. Compound interest is the interest you earn on your initial investment, plus the interest you've already earned. Over time, this creates exponential growth. For example, if you invest just 1 penny and it doubles every day for 30 days, you'll end up with over $5 million. This demonstrates why starting early and staying invested is crucial for long-term wealth building. Understanding the difference between assets and liabilities is essential for building wealth. Assets are things that put money in your pocket, like stocks, bonds, real estate, and businesses. Liabilities are things that take money out of your pocket, like loans, mortgages, and credit card debt. To build wealth, you need to focus on acquiring assets and minimizing liabilities. Risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. There are 3 main categories. Conservative investors prefer stable, low-risk investments. Moderate investors are willing to accept some risk for potentially higher returns. Aggressive investors are comfortable with significant fluctuations for the possibility of higher gains. Understanding your risk tolerance helps you make sound investment decisions that align with your financial goals. Now let's explore the main types of investments. Stocks represent ownership in a company. When you buy a stock, you own a small piece of that business. Bonds are loans you give to companies or governments. They provide steady income through interest payments. ETFs, or exchange-traded funds, are baskets of stocks or bonds that trade like stocks. They offer diversification and are great for beginners. Opening a brokerage account is your first step to investing. Choose a reputable brokerage platform, complete the application process, verify your identity, and fund your account. A pro tip for beginners: start with a low-cost index fund or ETF to build a diversified portfolio without needing to pick individual stocks. Building your first portfolio doesn't have to be complicated. Here are 4 simple and smart strategies. First, start small and invest regularly through dollar-cost averaging. Second, diversify your investments across different asset classes. Third, keep your fees low by choosing low-cost index funds. Fourth, automate your investments so you stay consistent. As a beginner investor, avoid these common mistakes. Don't try to time the market by buying and selling based on short-term price movements. Don't panic sell during market downturns. Don't put all your money into a single stock. And don't neglect to diversify your portfolio. These mistakes can significantly impact your long-term returns. The power of patience in investing cannot be overstated. Time is your greatest asset. Over 10 years, a consistent investment can grow significantly. Over 20 years, the growth accelerates. Over 30 years, you can build substantial wealth. The key is to stay invested and resist the urge to make emotional decisions based on short-term market movements. Now it's time to take action. Start your financial journey by taking control of your money, keeping learning about investments, and staying consistent with your investment plan. Remember, the best time to start investing was yesterday. The second best time is today. Begin your journey to financial freedom now.